How do advisors and their clients reconcile a soaring stock market with ongoing geopolitical and inflationary pressures? Hi, I'm Khang. In this video, we're discussing the outcome of the recent FOMC meeting and how the Fed's hold steady stance could evolve if the economic outlook shifts. We'll also dig into what these macro level risks can mean for the markets and for your clients' portfolios. At this week's FOMC meeting, the Fed decided to keep the policy rate where it is between 3.5 and 3.75 percentage point, which was the expected outcome. The market's pricing of no rate changes through much of this year exists for a good reason. On the inflation front, our view is that the Fed will be extra vigilant given the post-COVID experience and closely monitoring whether elevated energy prices are feeding into some parts of the core inflation, including transportation services and energy-intensive goods. They'll also be closely monitoring whether medium-term inflation expectation remains anchored. On the growth front, the economy is still growing at a healthy pace on the back of ongoing AI investment boom and fiscal support from the One Big Beautiful Bill. And the downside risks to the labor market seem to have moderated somewhat, despite AI-related chatters. Before the ongoing Middle East conflict, there was a sense that the current policy rate may be pretty close to the neutral rate to begin with. Now, with the upside risk that will remain for some time until a material resolution to the Strait of Hormuz situation, we generally see the Fed in a holding pattern for the foreseeable future. And the bar for a rate cut seems particularly high given this inflation outlook. Well, in a nutshell, we have similar stagflationary dynamics coming from the Middle East conflict at work in other economies as well. But given their energy dependence, Europe and Japan are both having to deal with a greater impact from elevated energy prices and more material weakening of economic activities. What does that mean for the policy rates? Much depends on the depth and severity of this energy price supply shock, and to be frank, we're still in the fog. But generally, relative to the US, the market is expecting the central banks to transition from a hawkish hold to actual hikes more readily and swiftly. Accordingly, should there be a clear resolution in the Middle East and the global energy supply chain, we may also see a greater change to this policy outlook. Macro risk doesn't always have to drive risk asset prices. Of course, they tend to go hand in hand when a new downside risk emerges and it looks like it could seriously threaten growth outlook, as it did in April last year with tariff announcements and earlier in March this year. But once the market senses that the very downside tail risk can be largely removed, this could also trigger the market to pare back much of the losses quite rapidly. And the current recovery in equity markets since late March is consistent with this view. There also may be a role of conditioning or learning at work here. Many drawdowns today's advisors and their clients have experienced firsthand over the past 15 years tend to be shallow in depth and shorter in duration than the bigger drawdowns that were suffered in earlier decades, such as the 2000s. Some ideas to just keep in mind in helping your clients reconcile today's situation. Number one, the market can be prone to become exuberant or complacent, driven by sentiment. It also tends to go from one narrative to another, so it doesn't always have to make sense in all investors' eyes at all times. Number two, that said, the market doing well doesn't necessarily mean there's no risk, certainly not macro risk, to be mindful of. As discussed earlier, many central banks recognize the potential for upside risk in inflation, as in year 2021 and 2022, there's no doubt that this is a key risk to monitor because if the upside risk inflation does materialize, it will have an impact on risk asset prices. And speaking of 2022, post-COVID environment does offer some food for thought for today's environment. Back in 2021, macro risk seemed under control for a brief moment, but inflation risk turned out to be critical and much more central later with the benefit of the hindsight. And in the equity markets, it felt as though it could support a very high valuation multiple. But in 2022, again with the benefit of hindsight, it became clear that the potential inflation risk of 21 was something all advisors and investors should have paid close attention to. So in closing, I'm not saying that the 2021 and 2022 past is a prologue to today's environment, but the 21 and 22 episode reminds us that sometimes it takes time for risk to play out. It could just diffuse or worsen. Only time will tell. And we can't control that as investors. But what advisors can control is keeping clients' portfolios broadly diversified, given their sense of where the key risks are. So portfolios have sufficient staying power when a downside scenario eventually emerges. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.